Something is happening in the silver market right now that most people in the West have not been told about. And the data is not subtle. It is sitting in plain sight in exchange reports, in open interest figures, in volatility readings that haven't been seen since a major price spike just weeks ago. And almost nobody in mainstream financial media is talking about it. What you are about to hear is not a forecast, and it is not financial advice. It is an honest walk through the data, the structure, and the signals that are currently visible to anyone willing to look. Stay with this until the end because the picture only makes sense when you see all the pieces together. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any asset. Silver, gold, and commodity markets carry significant risk. Prices can move violently in both directions, and past market behavior is not a reliable indicator of future results. This content is strictly educational. Always consult a qualified financial professional before making any investment decisions. Do your own due diligence. That is not a formality. It is the only real edge you have. Now, let's talk about what China woke up to. Shanghai Silver Futures opened at $99 per ounce. Western spot price going into that same open was sitting at $88.50. That is not a rounding error. That is a gap of more than $10 between two prices that are, in theory, supposed to be pricing the same metal. And that gap did not appear overnight. It has been building quietly and persistently for weeks, driven by something the paper markets in the West are not fully reflecting yet: physical demand. Before the Shanghai Exchange even opened for this session, the signal was already visible. Bids from physical recyclers in Shenzhen were running $5 or more above the last pre-holiday close on the Shanghai Futures Exchange. That kind of premium before an exchange session even begins is the market communicating in the clearest language it has. It is saying that the people who actually need physical silver, the ones who process it, refine it, manufacture with it, are willing to pay significantly above the prevailing paper price to secure it. That is not noise. That is price discovery happening in the physical world before the financial world catches up. Shanghai opened at 99, moved up to $102 per ounce during the session, and ultimately closed at 96. There is a detail worth examining carefully here. The session average was 96, but the final physical lot reportedly cleared at 102. Whether the average transaction price or the final clearing price better reflects the true state of physical demand is a legitimate debate among traders. But here is what is not debatable. Both numbers, 96 and 102, are materially above Western spot, which at the time of this session was sitting around $86. That is a premium of $10 at the average and $16 at the final clearing price. And during the entire Shanghai session, Western trading volume was nearly stalled. Low volume on the Western side, heavy premiums and elevated physical bids on the Eastern side. That kind of divergence between the paper price and the physical market is not accidental. It reflects a structural condition, and it has been deepening. Now, for anyone who follows short-term price structure, there is something worth noting in the Western tape as well. Over the past several sessions, a resistance zone between $87.20 and $89 has become increasingly significant. Price has tested that zone 3 times and rejected it 3 times. As of this recording, Western spot is sitting at $86.40 back below the zone. 3 rejections from the same level with no decisive, forceful close above it is how you read developing resistance in a market. The zone is doing its job until the price proves otherwise. What traders watching this kind of structure look for is not a wick or a brief excursion above the level. They want to see a clean, sustained hourly close above 89. That would represent a genuine displacement of the resistance and change the short-term picture. Until that happens, the level holds. But the short-term tape is, frankly, the least interesting part of this story right now. The options market is saying something far louder. The implied volatility index for silver options, which measures how much uncertainty and potential for violent price movement the options market is pricing in, has now reached 134. To put that in context, when this reading was discussed in a prior analysis, it had just broken above 100 for the first time in months. It is now at 134, above the levels seen on January 30th, when silver spiked to $120. Think about what that means. The price is currently sitting at 86. The volatility index is at a reading that, the last time it was seen, coincided with a price of 120. Both the options volatility on silver ETFs and the implied volatility on silver futures contracts are pointing in the same direction. The options market is pricing in the possibility of sharp, potentially disorderly price movement that the current spot price is nowhere near reflecting. That disconnect between a suppressed spot price and a screaming volatility index cannot persist indefinitely. At some point, one of them has to be wrong. Then there is what happened on the Shanghai Futures Exchange itself, and this is where the story moves beyond price charts and into something more structural. The exchange suspended another group of accounts for breaching trading rules during this session. That brings the total number of accounts suspended on the SHFE in the month of February alone to 23. During the session open, observers tracking order flow documented what appeared to be heavy manipulation attempts visible in the data, flagged in real time. The exchange's response was to suspend the accounts involved. This is not a conspiracy theory, and it does not need to be treated as one. It is the exchange itself, the regulator of its own market, confirming that the activity was serious enough to warrant formal action. 23 account suspensions in a single month. That is a verifiable number. Check the SHFE's own public disclosures. The settlement picture is where the pressure becomes most concentrated and most time sensitive. As of the most recent data, March open interest on the COMEX sits at 37,651 contracts. Each contract represents 5,000 ounces of silver. Run that calculation and you arrive at 188 million ounces of paper silver heading towards settlement within 3 trading days. Now look at the other side of that equation. Registered COMEX silver, the metal that is warrant issued, vault confirmed, and actually available for physical delivery sits at approximately 88 million ounces. That is roughly 2 ounces of paper silver for every 1 ounce of deliverable physical metal. The roll is underway. Open interest in May contracts has jumped significantly as long positions move out of March. But the roll has not been fast enough to fully eliminate delivery pressure. February 26th is the last practical day to roll March futures positions without facing physical delivery risk. February 27th is first notice day. From that point forward, shorts can begin issuing delivery notices, and any remaining long positions become eligible for delivery assignment. The clock is running, and it is not running slowly. What makes this more significant is the vault picture. Registered silver, the category that matters for delivery, has remained essentially flat to slightly lower in recent days. No meaningful new metal is entering COMEX vaults to replenish that registered inventory. The drain has continued while the paper claims against that metal have remained elevated. That is the structural reality underneath the settlement pressure. There is one more signal that informed market watchers are monitoring very closely right now. The carry-adjusted basis between March and May futures contracts. In a normal functioning futures market, contracts with a later delivery date trade at a premium to those expiring sooner. This is called contango, and it simply reflects the cost of financing and storing a physical commodity over time. It is the default condition of most commodity futures markets under normal circumstances. When that relationship inverts, when the nearby contract trades at a premium to the deferred contract, it is called backwardation. And backwardation in a physical commodity market carries one clear message. The market does not care what the paper price says. It needs physical metal now, not 3 months from now. As of this recording, the March to May spread has not confirmed a flip into backwardation, but it is approaching a level where that signal could emerge. If it does, it would not simply be a technical footnote. It would represent a fundamental shift in what the futures market is communicating about the availability of physical silver. Watch the CME's own published data on this. The financial historian Jim Rickards, writing in Currency Wars, described physical commodity market stress as the point at which financial warfare becomes visible, where the paper-based infrastructure that normally manages price perception begins to crack under the weight of real-world demand that can no longer be absorbed by synthetic instruments. That framing is not theoretical at this moment. It is a useful description of the observable gap between Shanghai at 96 and COMEX at 86. Now, zoom out further because the macro environment surrounding this is not getting quieter. Crude oil has moved to $67, the highest level since August. Bullish positioning in oil futures is rising, and the question being asked across commodity markets is whether that positioning reflects expected escalation risk in the Middle East, specifically around Iran. Separately, and more structurally, global oil discoveries have declined approximately 40% over the past decade. The average rate of new discoveries between 2015 and 2020 ran around 10 billion barrels per year. Between 2021 and 2025, that figure dropped to roughly 6 billion. New exploration, even if it began today, carries a 20-year lag before meaningful first production. This is a structural supply problem, not a cyclical one. When oil moves simultaneously on geopolitical risk premium and structural supply concern, it introduces a persistent inflationary input into the same macro environment that has already been driving both gold and silver higher for months. India just confirmed another record month for gold imports. This is not an isolated data point. Eastern physical demand for both gold and silver has been running at historically elevated levels for an extended period. The mainstream financial press continues to describe gold's move, which has carried spot gold to over $5,000 per ounce in vague terms. Momentum, speculation, excess. The analysis rarely engages with the underlying cause. What is actually happening is that institutional capital and sovereign buyers across Asia have been making a deliberate, quiet, and consistent judgment about where real value resides relative to paper financial claims. The World Gold Council publishes this data. The Indian import numbers are publicly available. Chinese ETF flow data is trackable. Anyone who engages with those primary sources directly, rather than relying on secondhand narrative, arrives at a different understanding of this move than the one offered by mainstream commentary. Now, the honest case for caution, because analysis without balance is not analysis, it is promotion. The Shanghai session today was instructive precisely because of what it did not do. Silver opened at 99, reached 102, and closed at 96. It did not hold the $100 level. Price discovery was volatile, and it ultimately settled lower than the open. That tells you something important. There is real selling pressure at these levels. Not just institutional suppression, but genuine market participants, traders with profits, risk managers with exposure limits who are willing to reduce their positions above $100. That selling is part of the real market too. The implied volatility reading of 134 is worth reconsidering in that light. The same potential for sharp upside movement that it implies carries equal potential for violent downside if a coordinated intervention, a margin call, cascade, or a broad risk-off event forces simultaneous selling across asset classes. Options markets do not distinguish between explosive upside and explosive downside. They price movement, not direction. And the fact that Shanghai is closing at 96 while Western spot sits at 86 does not automatically mean Western prices move up to close the gap. If physical demand in China does not sustain at current levels, Shanghai could move back toward Western pricing rather than the reverse. That is a legitimate scenario, not a fringe one. The market writer Humphrey Neal, in Tape Reading and Market Tactics, put it this way: the tape tells you what is happening, not when it finishes happening. The structural story is written in the data. The timeline is written by the market itself on its own schedule without regard for anyone's expectations or urgency. So here's what the data is actually saying, taken together without embellishment. Shanghai closed this session at $96 with a $10 premium to Western spot, and the final physical lot cleared at 102. COMEX implied volatility on silver options is at 134, the highest reading since January's spike to $120. 188 million ounces of paper silver are approaching settlement in 3 trading days, against 88 million ounces of registered deliverable metal. No meaningful new silver is entering COMEX vaults while that inventory continues to drift lower. India is printing record gold import figures. The Shanghai Futures Exchange has suspended 23 accounts for market manipulation in a single month. The carry basis between March and May futures is approaching a level that, if it flips, signals a condition the physical market has not experienced in years. And Western spot price is sitting at $86, 40 cents below a resistance zone it has now rejected 3 consecutive times. The paper market and the physical market are not telling the same story. They have not been telling the same story for several weeks. At some point, that divergence resolves. Whether it resolves this week, this month, or over a longer horizon is the open question. What is not an open question is the direction in which the structural pressure is oriented. Verify the CME volatility data yourself. Pull the COMEX inventory reports. Look at the open interest numbers. And when you do, separate what the data is actually saying from what you want it to say. That distinction between reading data clearly and reading it through the lens of a desired outcome is where most people go wrong. Not because they are looking at the wrong information, but because they are interpreting the right information with the wrong framework. The markets are not obligated to confirm anyone's thesis on any particular schedule. They reward patience, discipline, and the willingness to hold two things simultaneously: a clear read on the structural picture and an honest acknowledgement of what could go wrong. Manage your risk, protect your capital, and approach what is happening in these markets with the seriousness it deserves. This has been strictly educational. It is not financial advice, and it should not be treated as such. Do your own research, engage with primary sources, and make decisions based on your own circumstances and risk tolerance. Thank you for watching.